Welcome back to the Bitcoin Layer. I'm Nick Bhatia. It's time to take it to the classroom. We are going to teach you in a series, Bitcoin and liquidity. This is an enormous topic and a large undertaking, but it's time to take everything back to basics and build an entire foundation in a classroom setting, going through understanding Bitcoin and liquidity. Today's introductory class will go over balance sheets, corporate finance, and U.S. Treasuries. We'll start with balance sheets just to understand what are balance sheets and how can we understand them. Once we get into balance sheets, then we will start to learn about monetary hierarchy and layered money. That is how we can learn about the credit system. Once we understand the credit system, we can understand liquidity. And with all of that, we can introduce Bitcoin and understand why liquidity moves Bitcoin. So that's the main goal, the mission here, and we're going to go step by step until we get there. Now let's explain balance sheets. Let's get into some balance sheet 101. Okay, so we'll start from the individual's perspective. That way you can relate to what a balance sheet is and understand it from your own experience, okay? So in a balance sheet, we have what's called a T-chart. You draw the T-chart like this. Okay, we will be shortening this to A and L throughout the course. And you have assets and liabilities. This is what a balance sheet is, A and L. Left and right. Now, down here, you have something called equity. And equity is what you own. That's the way to think about equity. Simply, it's what you own. So, let's start at the beginning with you yourself. You have a job, and through that job, you get income. Okay, let's say you're starting from scratch, you have no debt, you have no assets, but you get your first job. And then over the course of a few months, you get salary and you start with, now you earn $100, and that $100, let's say you are paid in cash. So balance sheets always have to match on the left and the right side. They have to total to the same amount. So when you earn $100 and you earn that money in cash, what you own here, your assets, what you own is $100 in cash. And because you don't have any debt here, see, this is blank. You don't have any liabilities. This is, I'll just write debt in here so that you can think of it in a different way. If you have 100 in cash with no debt, that means that the 100 in cash is wholly yours, fully yours. So that's why it's equity. And you have 100 in equity here and 100 in cash. Now let's say you deposit that cash into a bank. All you're doing on the balance sheet is you don't have the cash anymore, but now you have a deposit of 100. Your equity's still the same. So to you, for your personal balance sheet, a cash or a bank deposit, I'll just write bank deposit here. A cash or a bank deposit are the same thing functionally to you. They're both assets. What if you put this deposit in a brokerage account and bought some stocks with it? Then you would have $100 worth of stocks. But the stock market can go up or down every day. So let's say the stock market goes down over the course of a week. it experiences some volatility. It goes down 5%. Your cash, your asset position, your stocks position went from 100 to 95. Therefore, your equity position went from 100 to 95. So what do you own in total now? It has decreased from 100 to 95 in this example. Now, let's introduce liabilities. So now let's say you want to buy a house. And the way that you can buy a house is by borrowing at the bank. And let's say you borrow $500,000 to purchase a house. So you borrow $500,000, then what will show up to balance the balance sheet? You'll have 500 in cash. And of course, this is not how it works functionally. The bank has to take the house deed itself as collateral. But I want to just walk through how you should think about a balance sheet and balance sheet exercises, because that's what we will be doing the entire course long. We will be doing balance sheet after balance sheet exercise. That's the only way to understand how this whole thing works. It's through the balance sheet. So my job is to teach it to you in easy to understand terms and drawings here for you. And in that way, you can build on your education. So we borrow $500,000 from the bank. We have $500,000 in cash. Now we take that cash and we purchase a home. So our asset is the home. We own the home as our asset, but we have a $500,000 liability here, and it's actually linked to the house. And what I should do here is I should, instead of link it to the amount, link it to the home itself, because the loan is collateralized by this home. So the balance sheet you see here, the balance sheet of you as a person grows. The left side and the right side grow. Your equity, interestingly, your equity doesn't change in this example because you've borrowed 100% of the home value. And so while the whole balance sheet grows, that doesn't mean that your wealth grows. The equity is your wealth, okay? Now we have our first example of a balance sheet. Assets, liabilities, and equity. And assets equals liabilities plus equity. So the left side will equal the right side. And when we introduce a new amount to the left side, it must be accompanied by something new on the right side and vice versa. And that's extremely key to understand how balance sheets work and how corporate finance works, because that's what we will need to build on to then get to treasuries. Over 10,000 investors downloaded the original How to Position for the Bitcoin Boom report when Bitcoin was 27K and it called for 120. The target is hit. What's next? Tour de Meester is back with the 2025 edition, refreshed for the mid-cycle moment. New data, new insights, and get Tour's latest price expectation. Plus, you'll get exclusive access to charting our way through chaos. Tour's new 30-minute Q3 2025 presentation. He explains why this bull run might just be beginning. Read the first ever mid-cycle report from Adamant Research at unchained.com/TBL. Never sell, just borrow with Arch Lending. Arch lets you borrow against your Bitcoin, unlock cash without selling, instantly access a Bitcoin-backed line of credit for as little as $5,000 for up to 2 years. There's no rehypothecation ever, and insured custody at Anchorage Digital. Stay long, stay liquid. Go to archlending.com/TBL and use code NIK, that's NIK, for 0.5% off of your interest rate. Now we're going to talk about the firm. This is Corporate Finance 101. This is going to be the tool for you here to then understand what it is that the U.S. Treasury Department does on behalf of the U.S. government. But first, we have to think about the balance sheet in relation to a firm, okay? We have assets and liabilities. Now, this is the way that I learned about corporate finance when I was studying finance, and I believe that this is a very powerful way to visualize how companies operate and how they leverage a balance sheet. Okay, we have the equity down here, liabilities and assets. Now, this is a brand new firm. And imagine that the founder has earned a lot of money. Forget borrowing for a second. Let's just say the founder has earned a lot of money in his career. He has a lot of savings and he's ready to take that savings and start a new company. That savings from the founder goes here. That's the founding equity of the company. That is a founder coming in and saying, I have money that I've saved up. I'm starting a new firm and I'm going to put capital into a new entity. This is that startup capital. Now, I can tell you right away that when this company starts a firm and this individual says, I'm starting a firm and here's the startup capital, that capital starts as cash. They might invest it in a money market fund, treasury bills, etc. But for all intents and purposes, it's cash. So you're balanced in your corporate finance example here, startup cash and the cash. Assets equals equity. Now let's say this individual is ready to deploy this cash into something that has to do with production. Why would the company want to produce? The reason the company wants to produce is for cash flow. A company's whole existence is to generate cash flow. And how can a company generate cash flow? It has to have productive assets. For example, this is the way that you should think about it here. And we're not going to write any words on any of these on this T-chart specifically. I don't want to write words because I want you to visualize these circles for a reason here. The equity that comes in starts as cash. Now we're going to convert this cash to a project. Okay? So this project itself here is what generates cash. So what is a project? Imagine starting a factory and you buy equipment into that factory and the equipment is able to take raw materials and turn them into finished goods and generate cash flow. Okay? A manufacturer. So one factory is starting to generate cash flow. Now, what happens to that cash flow? The cash flow ends up as additional equity. After expenses are paid, after employees are paid, if there is net profit filters back into equity. So equity, now you have more equity. That equity will be balanced by cash over here. Now we take this cash and convert it into another project so that it can generate cash flow. Now let's say the firm is ready to borrow money and start 3 more factories. Well, it doesn't have the equity to do it. Where are you going to pop up 3 factories here? You have to pay for them somehow. Well, I told you that it's generating cash flow, but this is the additional cash flow down here. This is the startup capital. So you have a factory and another factory. Where are you going to get 3 more factories? How are you going to get to 5 factories? You borrow. You issue 3 separate bonds in the market. And then you buy or start up 3 separate factories. And each one of those generates cash flow. So a corporation, what its job is to manage how much it's borrowing and how much it's raising from the capital market and balance that with the profit that it generates to determine how many projects to start and how to invest in its productive assets. That's how corporations work. They leverage their equity and their assets, borrow from the capital market or from banks, and with the borrowing, they can have more factories. But guess what? It's the same equity owner here. And I haven't even done an IPO yet. So the single equity owner started the factory with his first startup capital. Then he generated cash flow, started a second factory. Then he borrowed money for his third, fourth, and fifth factories, and he hasn't even issued an IPO yet. Now I say he issues an IPO. I said I wasn't going to write letters, but it's okay. I'll write project here, just so you can have that for your own benefit. So they issue an IPO, and with the IPO, you get a 6th factory over here. And all these factories can generate cash flow. And that's how corporate finance works. This is what I wanted to show you so that you can understand that a balance sheet is a tool. And it always has to balance left and right. And a firm is the best way to understand that. But then once you understand how a firm works, you can understand a little bit more how a government operates a balance sheet, how a Treasury department operates a balance sheet, as well as a bank. And how a bank operates a balance sheet, it's very different. And it requires a little bit of layered learning here. So we're going to now get to U.S. Treasuries and think about the balance sheet of the United States government. All right, U.S. government. Let's think about the U.S. government's balance sheet. And the U.S. government's balance sheet is represented by the Treasury Department. The U.S. Treasury is simply the way that the U.S. government accounts for all of its finances, meaning its revenues and its expenditures go through the U.S. Treasury Department, which is a department of the government. So when you hear the term U.S. Treasuries, that term refers to the debt obligation of the U.S. government, which is issued by its Treasury Department. Now, the government, we don't always think about the equity position of the government. And so I want to now bring that in so that you can understand what is the U.S. government's balance sheet? What does it look like? Because you can't just look at what they publish as their reports of their balance sheet. You have to actually think holistically. So what type of things does the U.S. government own? Well, it owns land, that's for sure. It owns equipment, such as military equipment. So we understand that the U.S. government owns things. Now, what does the U.S. government owe? Well, it owes approximately 37 trillion of U.S. Treasuries. And I will put Treasuries here in parentheses. You'll see me write USTs a lot. UST meaning United States Treasuries, Treasury obligations. These are bonds. Okay, so sometimes I ask my students, I will write all of this on the board, then I will say, hey, what is the size of the U.S. bond market? The US government bond market. What's the size of it? Well, the answer is right here. The size of the bond market is the quantity of the liabilities of the US government. So treasuries as an asset class are 37 trillion large because the US government has issued and has 37 trillion outstanding in treasuries. Now, what about the other assets of the government? What is it that backs these 37 trillion in treasuries? Why do people keep buying them? Why do investors keep buying these 37 trillion in treasuries? Is it because they view the government as likely to sell down its land and use the proceeds to pay back the debt? Definitely not. The reason that treasuries have standing as an investment is something called tax revenue. But tax revenue itself is not an asset. So, what is the asset of the US government that secures all of this debt? It's actually the citizenry. It's the US taxpayers themselves that are the asset because, or I should say the tax base. Saying the taxpayer, it isn't wrong, but more appropriately, the US tax base is the asset upon which the US government can borrow funds. What is another hidden asset here of the US government? It's actually their natural resources. Oil in the ground, for example. And so if the United States has natural resources as well, that is assets that really gets hidden in the mix when we look at the US government's balance sheet. They don't put that there's tens of trillions of dollars of minerals and oil and gas underneath the ground in the continental United States plus Hawaii and Alaska. So in that way, the equity portion of the US government is a question mark. We don't know how much equity the government has here. And that in that way, we don't actually know the limit of the quantity of liabilities that the US government can access. But I wanted to explain to you that the 37 trillion, which is the size of the liabilities of the US government, is only one piece of the puzzle, which is that assets equal liability plus equity. Well, what about all these natural assets? What if the natural assets is $200 trillion? And we could even include the productive capacity of the citizenry in that, because the citizenry is right here, and they're the ones that can leverage natural resources in the private sector. So if that is the case, what is the equity position of the US government? It could be massive theoretically, even though 37 trillion seems like a lot, because all you're doing is looking at the tax revenue, which is simply a function of GDP. That's why people think about debt to GDP. They're thinking about debt to GDP, which can generate that tax revenue. So that's the ratio they're thinking about. But they're not really thinking about nature, the land, or I would even argue the spirit and innovation of the American people. There are a lot of hidden components to a government's balance sheet. And that's something that I want us to think about as we're getting into bank balance sheets. In bank balance sheets, there's nothing hidden. It's all there. It all has to balance. Now, banks can do off-balance sheet activity, but it still will filter through their income statement and can blow up the bank at any time. So that's not really what we're talking about here. We want to lay the foundation between personal balance sheets, corporate balance sheets, and the U.S. government balance sheet. That is how we understand what treasuries are. In our next lesson, we will go deeper into US treasuries. What are these instruments? And getting to understand them a little bit better so that we can understand then liquidity, because liquidity is dependent on collateral in the system. And there is no collateral like the United States Treasury security market to make the banking system function. So, one step at a time. Thanks for sticking with us today at the Bitcoin Layer. We'll catch you guys next time.